In this video, I'm going to be reviewing the top 3 dividend ETFs on the Australian Stock Exchange. Now, not all dividend ETFs are created equal, and as an accountant, I've seen firsthand how big a difference the performance can be. So I'm also going to break down the pros and cons of each ETF and who they might be suited for. Let's go. The first is VHY, or as I'm nicknaming, the Balanced Big Dogs ETF. And VHY is the Vanguard Australian Shares High Yield ETF. And this fund aims to give investors exposure to ASX listed companies that have a higher dividend forecast relative to their peers. VHY launched in 2011, so we have a good amount of historical performance data, which we'll go through later. And as at the recording of this video, it has $7 billion in assets under management, which means basically the value of the shares in the ETF is around $7 billion, which puts it in the top 10 ETFs in Australia in terms of its size. And this shows a strong level of confidence, a strong level of trust from Australian investors. The current share price is around the $80 mark. All these ETFs charge a management fee, and the fee for VHY is 0.25%, which is about on par with what other ETFs are charging in Australia. So what this basically means, for every $1,000 you have invested, you pay $2.50 in a management fee. But the good news is you don't pay that out of pocket. It's automatically deducted from the fund each year before you receive your dividends. This fund is domiciled in Australia, which means it's governed under Australian law. So that should give you a little bit of peace of mind. It also means they send you a statement each year to help when you complete your tax return. And this is very, very helpful and makes that tax return process much simpler. Most of these dividend ETFs hold similar shares. So what we'll focus on is the top 10 holdings, because that makes up about 70% of the fund. And there is a little bit of a difference between these top 10 holdings between each of the dividend ETFs. For VHY, the top 10 holdings are heavily exposed to the big miners and the big banks. Companies like BHP, Commonwealth Bank, Westpac, Rio Tinto, Woodside Energy, and Macquarie Group. Now let's actually talk about the dividends. The dividend yield, which is the dividends received during a period of time divided by the share price. So the dividend yield for this ETF over the long term is between 5 and 7%. So what that means is on a $10,000 investment, you would receive roughly $700 a year in dividends. And these dividends are paid quarterly to you. And as these are Australian companies, you also receive franking credits with your dividend. And Australians love their franking credits. So what this effectively means is a portion of the tax has already been paid for you by the company on this dividend. So depending on what your tax rate is, you may just need to pay a little bit of top-up tax. So that's the dividend yield. Let's now talk about overall performance. So since inception, this fund has averaged around 10% return per year. Not too bad. However, this is lower than the market average return over the long term, which is around 13% per year. And I'll explain why that has happened at the end of the video. Some of the pros and cons. So these are big Australian companies, which is why you're getting such a high dividend yield when you own this ETF. Big Australian companies generally pay big dividends. However, these companies do not pay out all their profits. So when companies do pay out all their profits, sometimes the growth is limited and you're limited to just the dividend return. So because these big Australian companies are not paying out all their profits, in addition to your dividend return, your dividend yield, hopefully you should also get a little bit of growth, a little bit of increase in the share price. This ETF has a good balance in companies and sectors between the big miners and the big banks. And it's also run by a well-regarded company in Vanguard. The next ETF has the ticker SYI, which I'm nicknaming Money in the Banks. And this ETF is by State Street and is the MSCI Australian Select High Dividend Yield ETF. And State Street is another one of the big ETF providers, along with Vanguard, BlackRock, and BetaShares. SYI was launched at a similar time to VHY in 2010. However, its assets under management is much, much lower at around $600 million. Now, this is not always a bad thing. It's reflected in the share price. So at filming, the current share price of SYI is around the $30 mark. The management fee is slightly lower than VHY at 0.2%. So on a $1,000 investment, you pay around $2 in management fees, so absolutely nothing. This ETF is again domiciled in Australia, so subject to Australian laws, Australian regulations, and Australian tax requirements, which is also helpful. And when talking about the top 10 holdings, this is where we get a little bit of difference between the ETFs. The fund holds around 58 stocks, with very much similar stocks to VHY. However, the top 10 stocks are very much heavily skewed to the banking stocks, hence the nickname Money in the Bank. But there are a few other distinct differences. Whereas VHY had BHP and Rio Tinto in its top 10, SYI does not have those in its top 10. Instead, it has companies like QBE Insurance, Coles, and Santos. So this is where you can customize a little bit and choose the ETF that you want more exposure to. So if you look ahead and think you want more exposure to the miners that are doing metals and iron ore, then VHY is much more aligned to that. However, if you want more exposure to gas and the supermarkets, SYI gives you that different exposure. Let's talk about dividend yields. So over the long term, SYI's dividend yield is around 6.6%. So on a $10,000 investment, what that means is you'll roughly receive $660 per year in dividends. And these are also paid to you quarterly. Now, in terms of overall performance since inception, this ETF has averaged around 8.1% per year, so slightly lower than VHY. Talking about the pros and the cons, again, these are the big Australian companies, so you're getting that high dividend yield, and hopefully you should get a little bit of growth as well in your overall return, similar to the VHY analysis. However, the key difference here is what kind of investor that you are. If you are a beginner investor, if you are just starting out and you have small sums of money, then it might be much more difficult for you to save up to buy an $80 share in VHY compared to a $30 share in SYI. It might be easier for you to afford those SYI shares. So that could be a key consideration. What part of your investment journey are you on? Having said that, I would say the most important consideration and the key consideration is the overall return. So make sure you also keep that in mind. And then thinking ahead, thinking about the future, what kind of exposure do you want? Do you want more exposure to the big precious metal miners, the big iron ore miners? Or do you want exposure to supermarkets and insurance banks, those sort of things? The next ETF has the ticker HVST, which I'm nicknaming the Chop and Change ETF. And this is the Beta Shares Australian Dividend Harvester ETF, which seeks to buy big dividend paying companies just before they're about to pay a dividend. So this fund rebalances, which means sells down positions and buys new positions quite regularly, about every 3 months. This fund started a bit later in 2014 and is smaller again with about $200 million in assets under management. Now this again is reflected in the share price. At filming, it's around $13 per share. In terms of its management fee, this fund is a little bit more active, and as you get more active funds, they typically charge a higher management fee. When they're actually going and doing things regularly, that's what's called to be active. So this fund, because they're buying and selling companies typically just before they're about to pay a dividend, their management fee is around 0.7%. So on a $1,000 investment, you pay about $7 a year in fees. This fund is also domiciled in Australia, so it's governed by Australian law and tax law. And in terms of the top holdings, it's not as relevant for this ETF because they are changing so frequently. But just for consistency, we'll go through them to compare them to the others. So this fund holds anywhere between 40 and 60 shares. And as I mentioned, it rebalances every 3 months. And its current top 10 holdings are very similar to the VHY holdings, the companies like BHP, the big 4 banks. The 2 key differences are that it holds CSL and Westpharma. So it gives you exposure to that pharmaceutical space and the supermarkets. Talking about dividend yields, the long run average for HVST is between 6 and 7%. So on a $10,000 investment, that's roughly $600 a year in dividends. And the important difference here is that these dividends are paid to you monthly. So if you enjoy more regular cash flow, that could be a key consideration for you. Talking about performance, since inception, this fund has averaged around 8.9% return per year, so quite similar to the return of SPY. Talking about the pros and cons, again, you're getting the big Australian company, so you're receiving the franking credits on your dividend. Its return is quite similar to SPY. However, what I would say is because this is more of an active fund and you're paying a little bit more of a management fee, you would expect a little bit more of a higher return as a result of that. Now, the management fee between $2 and $7 is not much at all. But generally speaking, when you start to move to more actively managed funds, you typically should expect a bit of a higher return, meaning because you're paying for a service, you should receive a little bit of a higher return. And it wasn't that evident in the returns of HVST. Depending on where you are in your investment journey, the share price is much lower than the previous two ETFs. So that could be helpful, could be beneficial to more beginner investors while you're starting out. Again, I would reiterate, total return is a much more important metric, but that could be a key consideration that you take into account. And another thing that's quite unique about this ETF is because it rebalances so frequently, the fund would also have some capital gains and capital losses, which it would distribute out to its holders. So if in your personal name you have quite a large number of capital losses, you might be able to reduce some of those capital gains that you've received from the fund with your own personal capital losses. So this is unique because this fund rebalances so frequently. So its capital gains and its capital losses that it have, there would just be more of them because it's rebalancing. So that's another consideration, your personal profile, and if you're carrying any capital losses. So my overall thoughts, Australian companies typically pay high dividends compared to the rest of the world. And the reason for that is our unique tax system in the franking credit system. Because we have franking credits, it typically incentivizes companies to pay those out as dividends. So Australia typically has high dividend paying companies. In terms of the funds that we reviewed, Vanguard was the biggest that we reviewed and had the highest returns to date. And it has primary exposure to the big miners and to the big banks. So as you look out into the future, if you think those will be fields that will be really important to the Australian economy, that could be a key consideration that you have. And the other two that we looked at, their performances were slightly less than the VHY. However, their share prices were a lot smaller too. So depending on where you are in your investment journey, it might be more suitable for you to look at those cheaper share prices. Also noting that they give you a bit of different exposure. SYI, more exposure to gas and to the supermarkets, and HVST, more exposure to pharmaceutical and the supermarkets. So if $80 is hard for you to scrounge together, that could be a key consideration that you have. Another key consideration is that HVST is the only one that pays monthly. So if you value having more cash more regularly, instead of waiting for a quarterly dividend payment, that could be a key consideration. However, what I would say is the key consideration, so the average return of the entire Australian stock market over the last 100 years is around 13% per year. And the ETFs that we reviewed, their returns topped at around 10%. Why is that? So the reason for that is because these are such high dividend paying ETFs, you're paying for that certainty of the dividends that you receive. The return is a little bit less than the average market return. So you're paying for that regular cash flow, the dividends on a regular basis, that certainty. So because you're focusing on that, the total return is a little bit smaller. So one of the key considerations I would have is make sure you have a balanced view and a balanced opinion about what kind of ETFs you hold and what kind of stocks that you hold. If you limit yourself to just dividend ETFs, you'll be capped out at around that 10% per year. If you broaden your horizons, you may open yourself to higher returns. My name's Tomo, and the value that I bring is I explain really difficult financial concepts in an easy to understand format. So if you enjoyed the video, please hit the like button. And if you want to hear more from me, consider subscribing to the channel. Now, please keep in mind, I'm not a licensed financial advisor. This video is for entertainment, education only. Nothing in this video is a buy recommendation to buy any of the ETFs that we discussed today.